Hello, everyone. Welcome to today's webinar, Startup Fundraising, presented by Early Growth Financial Services. My name is Amanda Young, and I'll be your moderator from the Early Growth team. I just have a couple quick notes before we get started today. The webinar will last about 60 minutes, including some time at the end for questions and answers. But we will also take questions throughout the presentation. So go ahead and type your question into the control panel, and I'll try and jump in and ask those when possible. Also, this webinar will be recorded and sent to all of the registrants within 48 hours. You can also find this recording and all of our other recordings of webinars on our YouTube channel, which is just Early Growth. So now I'd just like to tell you a little bit about Early Growth Financial Services. This is a quote from our founder, David Ehrenberg, and also just a couple of the companies we've worked with. So Early Growth is an outsourced finance and accounting firm. We work with early stage companies, helping them with everything from day-to-day accounting to financial forecasts to taxes and valuations. So pretty much anything accounting that you could need, we help you with. So now, without further ado, I'd like to introduce today's presenters, Alaa and Sirk, and I will pass it off to them to introduce themselves.
Since I'm on the left-hand side of the slide, I'll start, Sirk. Hi, my name is Alaa Ismail. I'm a consulting CFO at Early Growth. I've been with the company for close to 9 years, and I work with all sorts of companies in very early stages to late development stage, and I have clients in the software as a service, consumer products, manufacturing, and e-commerce spaces. I really enjoy working with early stage companies and watching them develop into very, very successful entities.
Hello, everyone. This is my name is Sirk Rowe. I've been with Early Growth for 5 years now, so not nearly as long as Alaa, but I consider myself one of the veterans. I also support a different types of companies, including SaaS companies, consumer products, hardware, social networking sites, and like Alaa, the thing that we love doing here at Early Growth is working with early stage founders and early stage companies to assist them to be successful and to grow. So thank you very much for spending time with us on this webinar.
Great. So let's go ahead and get started. So I'll pass it off to Alaa to get us started.
Right. So the main topic here is to address fundraising concerns that you may have, and we'd like to start off with some of the reasons that you may want to raise funds. And let me kind of preface this by raising money is not necessarily the goal. And I find very often that entrepreneurs, especially here in Silicon Valley, view as raising a fund as kind of the success metrics that they have. Keep in mind that the primary reason for you to raise funds is to expand and grow your business, and to be able to reach success earlier. Raising money in itself is not the end goal. So raising money is really not for a product or for personal or market validation. It's to accelerate your growth. So it allows you to get to market early. In today's technology world, that is a key driver. So to the extent that you could raise money to hire folks or to accelerate your product development cycle and get to market earlier, that is a significant advantage and a necessary, and raising a round of funding to get you there is absolutely necessary. One of the other reasons why raising funds could be important is to expand your network and give you a bigger reach, whether that's a strategic investment through a company that could help you grow, or it could be an opportunity to acquire technologies that that would be difficult for you to buy or to develop on your own. And finally, and probably most importantly, raising money will allow you to accelerate timing, and time to market is so critical right now. So in especially the technology world, if you're the first or one of the first to market, you have a huge competitive advantage. And if you could raising funds to exploit that is really, really a critical and an important item for your success. Next slide, please. So we'll go over kind of your funding options and in your business and during the life cycle of your business right now. This graph essentially shows the different stages and the various options that you may have, and we'll get into those options in a little bit more detail later on. But obviously the range of options goes from bootstrapping your business to friends and family. Crowdfunding is a very, very popular source of fundraising right now. Venture debt is kind of an offshoot to bank investment. The more typical and more common investment cycles that we see in Silicon Valley and in some of the other technology hubs is you start with an angel investor. You maybe graduate from an angel to a venture capital. As you become more developed and more established, you might invite a strategic investor to help you with your growth or your product development cycle. And finally, there are banks. Banks are really not set up to fund early stage companies that are losing money or don't have any revenue. So banks in themselves tend to be in the later parts of your company or the later life cycle. So this graph kind of shows where these funding sources typically fall. In the very early stages, bootstrapping, friends and family, VCs, angel investors are more common. And then as your product or your business kind of is more developed and you're perhaps in revenue mode, other investment sources like strategic investors and banks become available. And ultimately, maybe an IPO is in your future. Next slide, please. So let's start with kind of digging into some of the different sources. Friends and family sounds like a kind of a trivial source of funding, but in my experience, I find that a very large percentage of companies start by a friends and family type investment. You have a great idea. You have somebody that is either interested in your idea or is related to you, or somebody with funds that believes in you and starts off the funding. And typically a friends and family round, the obstacles that folks have is, how do I get that money into the company in a way that ensures the investor that they have an equity stake, and at the same time also gives me time to grow the business. So one of the more common ways that friends and family gets funded is through a convertible debt. Convertible debt is typically a debt instrument that is not tied into a valuation right away when it's funded. So in the early stages of the company, you don't have to worry about whoever is funding you through this convertible debt to figure out what that valuation is. And typically the money comes in the form of debt. It's not repaid immediately. And as a matter of fact, during the term of the convertible note, there's really rarely any payback provisions. So any interest that is attached to it is usually accumulated and deferred until an equity event. Convertible debt usually has provisions in there that says, okay, when you raise a round or when you formally raise a round, this debt converts into that equity. It has terms that typically allow that convertible debt holder to convert into the next equity round at a discount, so anywhere between 10 to, I've seen as much as 30–40%. So, and it allows you to roll your accrued interest on top of the principal into that equity round. The primary advantage with a convertible debt instrument is that you push forward the valuation event to the future. So when you have an angel investor or when you have a friends and family who's not savvy, they don't have to worry about the valuation. So you don't over or undervalue your company in the early stage of your development. The other thing about the convertible debt is that it's very simple. There's a lot of things. There's a lot of samples out there. The law firms are very tied into it, so it's something that can be done very, very quickly. And when you're raising money from friends and family, just make sure that you're very transparent with them, that you're telling them the risks, and that this is not a guaranteed return. A lot of folks, in their zeal to be successful, misrepresent themselves to people that are dear to them, and they're not very transparent, and that causes problems down the road. And when you take money, make sure that you're taking money from people that can afford to lose the money. It's very risky, and a lot of folks in the friends and family world think that investments and their belief in you kind of gets emotional, and they believe that they're going to get a return. So if somebody's life saving is coming to you in forms of friends and family investment, I would tend to shy away from that unless somebody could afford it.
Yeah, we talked about the kind of the Thanksgiving dinner, right, and whether you would feel comfortable. So if you took money from an uncle or brother or sister, and for whatever reason it was not successful and you lost all of their money, would you feel comfortable? Would they feel comfortable sitting around over Thanksgiving dinner? We'll have lots of opportunity in our lifetime to make a lot of money. Money will come and go, but obviously family and friends are once in a lifetime. And so make sure that that we think through that before we take money from friends and family.
Yeah, excellent point, sir. The second tier of investment in the early development stages of enterprises are usually angel investors. Angel investors come in the early days. It was essentially somebody who believed in your vision, was not necessarily an institutional investor. They may not have been a friends and family. They may not have been a sister, brother, uncle, or something like that, but more of somebody who is very interested in either you as an entrepreneur or your idea as a business. But the angel investing world has now morphed into kind of grades. There's the individual angel investor who believes in your idea and your vision and rarely invests except in the instances where they believe that. There are super angels, or that is somebody that is a little bit more dialed into the angel investing world. That's an individual that might, for example, invest in a certain market segment or a certain development. They may have a handful of companies that they invest in. So they're not a pure angel, meaning just a one-time investor thing, that this is something that they do and have dedicated funds, but they don't have a large pool of investments. And they tend to focus very early on, very early stage companies, from idea inception to maybe the first few hires. And then finally, there are right now angel networks, which are they may invest in not just a handful. It might be a larger group, but it might be a certain industry. And they usually have a lot more funding capability. And as a result, when you go down from an angel investor down to an angel network, the closing process or getting this money becomes more and more difficult. An angel investor, you could just have to sell one person on an idea. And once they bought in, it's a very, very quick method. An angel network might involve pitch decks and getting more people involved and selling them on your idea. So the complexity, even though it's an angel investment, there's also gradations of complexity within this category. Next slide, please. So angels in general are, come in different flavors. They could be somebody that is not in your immediate network, somebody that you may not have kind of a relationship with. Typically, an angel is are high net worth individuals. Sometimes the angel investors are not very sophisticated, so they're not familiar with the process. So you have to, in addition to selling them on your idea and your business, also kind of walk them through the process of investing in the early stage company. So you have to be a lot more involved, a lot more hand-holding. Sometimes these angel investors kind of are very, very small. They don't have a lot of funds. So instead of giving you, $3 or $4 million, they're giving you 20, 30, $100,000. The angel investment world, you usually will have one point person or one individual, and the process is very, very quick, and usually doesn't take any more than 2 or 3 months to close a round with an angel investor. Next slide, please. A super angel is, like I mentioned before, is more institutional. They may have a handful of companies. Excuse me. They function more like a venture capital. So they typically will have a process. They may be a lot more sophisticated. So they might have, in the case of a super angel, and they want to do a venture, a convertible note, they might have their own agreement already set up. And typically in most of the angel rounds, like I mentioned before, the investment vehicle is through a convertible debt. And typically super angels like that as well, because they're not buying into the valuation just yet. They're buying into the idea. So they don't want to worry about that. They want to have somebody more, they want the market to set the value and want you to be down the road a little bit. So that's usually the differentiation between a single angel and a super angel. Next slide, please.
Well, I have a quick question, if you don't mind. If an investor is interested in giving you money and they want stock in exchange, how can you mandate that if we need to go to the till, they are not privy to more stock?
Yes, they need to go to the till. So I think, if I'm getting the question properly, if you're going to give stock, you have to worry about what the valuation of the company is. And that's why in the very early stages, angel investing becomes difficult, because how much stock is that investment worth? And once you start getting into that, you have to worry about the value of your company. So if you're in a very, very early stage, it's very difficult to figure out what that value is. It's not that it's not done. It is done, but you have to worry that you have to be concerned as an entrepreneur not to give away too much of your company early on when the need is great, and at the same token, maybe not undervalue the investment early on and have a disgruntled angel investor later on.
Yeah, and I'll add one more thought to that, because Alaa is absolutely right. The key here, if you get a question at this stage from a potential investor who's interested in stock and how much stock am I getting and how much of the company am I owning, and those kinds of questions, the key is to really, really understand the funding vehicle, in which in this case in most likely cases it's going to be a convertible debt, for you to understand what those terms are and how that and being able to communicate what that means to the investor today, in terms of what they're getting for the money that they're investing, and what that investment will turn into or can turn into when that convertible debt converts into equity in the first round of equity financing. And it's probably a little bit more in depth than we want to get into on this presentation, but I encourage you to kind of study up on convertible debt and how that works. Because you're gonna get this question, and you're gonna need to be able to explain as concisely as possible, what it exactly means and what the investor's getting.
So angel networks are, in my opinion, more function almost exactly like a VC group. It's usually a group of folks. They have a lot more available funds. They focus on various industries. You could have an angel network that will have several market segments that they invest in, and have folks in their network that specialize in those segments. Typically, the fundraising process with angel networks it differs from a VC round in that they only invest very early on. And their hope is to get the diamond in the rough and pick a company early on that is going someplace, and as a result, get a lot more equity in that entity. But the raise process with an angel network is a lot like a VC, where you would have a pitch. They usually have some kind of a committee that decides on what to invest and how much to invest and so on. And they usually do a due diligence process. That due diligence process could be as simple as just talking to folks that know you, or it could be more in depth by getting into your product plans and so on. But an angel network in the early stages feels a lot like the typical VC round of funding. So you would have to prepare yourself with a pitch deck, a presentation, and also expect a longer close cycle. Angel networks don't necessarily invest in the typical rounds of financing, whether it's a seed round, A round, or whatever. They also invest in convertible notes, and they are savvy enough to know that convertible notes work really well in early stages for the valuation reasons we've given earlier. So an angel network doesn't necessarily mean that you're going to be in a seed or an A round of funding. But the biggest differentiator is really the process and the folks that you're dealing with. Next slide, please. Micro VCs. This is kind of very granular here, but it's kind of a new kind of VC that's out there. They're usually kind of a smaller VC. It's not the Google Ventures, Kleiner Perkins, Sequoias of the world. It's smaller funds. Instead of in the hundreds of millions of funds they have available for investing, they usually have in the tens of millions to invest. They usually focus on early stages, so it's anywhere from seed to A round. Very rare do they get involved after that. They're not there to be with you during your whole life cycle. They're only going to be there till maybe your B and C round, and typically they'll pass it along to other people. Not because they're not interested in you anymore. They're just not set up for that kind of funding for the larger rounds. They are very, very focused typically on market sectors. So for example, they may concentrate on B2B or B2C. They may look for certain regions. There are micro VCs that specialize, for example, in green technology. There's micro VCs that specialize in water technology. There's social VCs that invest in socially forward or things like environmental companies. So there's a lot of different flavors for these micro VCs. And because they're in line with, if you're approaching one of these folks for funding, they're usually in line with your vision. So they're very, very sympathetic to your business model, and they'll understand where you're going a lot easier. And especially if you're in a segment that may not be typical. Up to a few years ago, a lot of these micro VCs was revolving around the cannabis industry. And it turns out that those micro VCs are very, very successful now that the cannabis industry has grown. And they're now being very, very successful. But early on, they understood the space, and folks that were in that industry were able to raise money a lot easier because they understood the business and they understood the risks. So essentially, that's what micro VCs, how they differentiate themselves.
Hey, Alaa, I have a question. This goes back to the last slide, but sure. Can you explain about how angel networks have a convertible note cap?
Note cap?
Yeah, a cap on convertible notes, it says.
Sure. So typically a convertible note will come to you with terms, and the terms of the note, besides, of course, the dollar amount, they will have the interest rate. They will have how and when the note can and will convert. And typically they will say, okay, it's usually a minimal threshold of when that note can convert into a round, meaning that when you do raise an equity round, then it sets the parameters of when that note will convert. And also it doesn't, a lot of the terms will cap the amount of money that you could go out and raise in the equity round, excuse me, in the convertible note. So they will have a cap. So say, you know, you can't raise more than $5 million through a convertible note. And the other term, of course, is the interest rate and the discount rate, or the rate that the amount of money that was invested in the convertible note, the discount they will get in the next round of equity financing. So those are the standard terms in the venture debt round.
Hey, Alaa, I think what the question might be relating to is the valuation cap of the term, and if I understood that correctly, Amanda. And really, what it is, there's two ways that the convertible debt will turn into equity, and these are spelled out, and the actual investor gets to choose which one, right? So you can do it at a discount to the amount that you invested. So, for example, if the equity round of financing is valued at $1 a share, and you've got a 20% discount in your agreement, then you would actually purchase shares at 80 cents a share instead of $1 a share, which is what the equity investor will come in at. The valuation cap is the opposite one, which kind of protects the investor in the convertible. And let's say, for example, they invest money and they think that the company is worth $5 million, and they're putting in some money, and they're kind of doing the amount of money, the amount of the company they're going to own based upon that. Well, let's say you take that money and all of a sudden you really knock the ball out of the park, and you've made tons of progress. And when you actually go for that round of financing, the company's not worth $5 million, it's worth $10, $15 million. Well, you can imagine that at that valuation, the person who put in that convertible debt initially is going to get a much smaller percentage of the company. And so the valuation cap, what that says is that, hey, the terms may say that, you know, the valuation cap is going to be, I'm maxed out at $6 million, which means that no matter how much the company is valued at, my convertible shares are going to convert as if the company is worth only $6 million. And so it really protects the investor and make sure that, you know, that they don't get squeezed out, and you know, in the case that the company is worth a lot more than they thought it was going to be worth when they first invest. I think that's probably what the question was about.
Yeah, she just clarified, so you got it. Thank you.
Thanks so much. So we'll go over next the different funding vehicles that are out there as well. Venture debt is not a funding vehicle in its own. It's usually an offshoot to a funding round. So the way when we look at venture debt is provided by a whole host of lenders out there. They look at a company shortly after they've raised a venture round. They rely on the expertise of your investors in that they did due diligence, they bought into your idea, they have a relationship with those VCs or investors, so they piggyback on that reliance and they come in with a debt round. Usually, so if you've raised, for example, an A round of financing of $5 million, a venture debt lender will come in and say, well, based on that, you might need some additional funds. We're here to offer you another $2 million. We've done our due diligence. We've talked to your VC investors. We really like your company and we're willing to take that risk. And it will give you a couple of $1 million of availability on top of that. So the reason why venture debt is important is typically that's provided by lending institutions like banks. And as you know, when you don't need money, banks love to give it to you. But it gives you an opportunity to extend your cash runway. Why is that important? When you're about ready to raise the next round of financing, maybe you've reached a certain milestone, the timing of that is unpredictable. So if you're running out of money and you need the money right away, the fact that you need it, the investors may capitalize on that and affect your valuation. So if you have a venture debt line that extends your runway, you may be able to negotiate better valuation terms, and that is extremely valuable. So the interest rates and the terms that the venture debt provider has is a lot better than the equity that your valuation that you're going to gain by extending your runway. Like I mentioned before, venture debt is usually based on a VC's commitment to you. So so they will the venture debt providers and the VCs are very much aligned. So they will the bank will rely on the VC, and the VC is beholden to the bank. So it is a secured, venture debt is secured. So a lot of times that vehicle will be secured by all of your assets. But in addition to that, the venture capital community do not want to misrepresent or have a bad reputation with a lot of these venture debt providers. So when companies are in trouble, venture debt usually gets paid off very quickly. I've seen situations where the actual investors are more concerned about paying back the venture debt than they are about the ongoing operation of the business. But that aside, the venture debt is actually a very convenient vehicle if you are planning multiple rounds of financing. My recommendation in a venture debt is to get it early on after you've raised either a seed or an A round of financing, because that's when it'll become available to you. And use it towards the end of your of its availability to extend the runway to get maximum valuation for the subsequent funding round.
Alaa, could you explain? Sorry, go ahead.
Go ahead. I'm sorry. Venture debt usually not only carries an interest rate, and but it's usually does not carry any financial covenants, but it does have warrant coverage. And if you get into a venture debt agreement, make sure that you have proper financial advice to help you negotiate the terms, so you're not being taken advantage of. Go ahead. The question, Amanda?
Yeah. Can you explain what dilution is and how it affects your valuation?
Dilution is essentially the decrease in the ownership that you have in the company. So if I originally owned 50% of the company, and as a result of my my raising around now own 25% of the company, then the dilution effect of that raise has been a 50% cut in my equity stake in the company. Typically, as the company raises more and more rounds, if you're not investing with each round, you're being diluted, meaning that the percentage ownership of the company is decreasing as the company raises more and more money. So that's essentially what dilution is. The decrease in valuation of the company. The decrease in ownership of the company, excuse me. Am I still on?
Yeah.
Oh, okay. I hope I am. Did I get that, Sirk?
Yeah, absolutely.
Okay.
And basically any type of equity round of financing, or any time you give away equity, you're going to be, any existing shareholders are going to get diluted, which is why obviously you want to be careful about how much equity you give away, and where venture debt that we're just talking about is a great source, because you're not giving away more equity and you're not diluting yourself or your other investors.
Right, exactly. So traditional venture capital is typically a much greater capital investment, a lot more money that you're going to raise. If you raise money with a venture capital company, usually you have a much bigger network. Raising money with VCs is not just the fact that you have availability to a lot more funds, but right now VC funding comes with a lot more perks. Typically, when a VC gets involved in a significant investment in you, they're going to ask for a board seat. And if they're part of your board of directors, that means they're going to be a lot more involved operationally. There's a great value in VCs besides the money. Their network is really gold for you, because it not only will connect you to potential customers, but it'll be a great source of consultation. You might be able to access their network of advisors. They have a lot of similar companies. They might introduce you to other portfolio CEOs, so you have a support group that you could kind of bounce ideas off of. So there's a lot of advantages to being with a really good venture capital that understands a firm that understands your business and could be a great value add. Venture capital, however, is not an easy process. Especially some of the larger firms, they have literally dozens of term sheets of proposals on their desk, and they have lots and lots of red tape that you have to go through. So it's become a situation that they rely
I think you
more
just cut
on.
out a little bit.
Oh, I'm sorry. The traditional venture capital is a lot more complicated. It involves a pitch. It involves investment groups. They are very savvy, so they will negotiate a lot harder with you. So that means that there's a lot greater dilution. By dilution, we mean less ownership of the company after the investment. They will be more involved. Typically, a large investment will mean that they'll be part of your board, so they'll have a lot of power that comes with that. And but with the increased investing and the higher profile of the VC will also mean that you have greater expectation. They're not investing in you just because they like you. They're investing in you because they want to make money. And to the extent that you no longer, as an entrepreneur, have a controlling stake, and you've raised enough money that these institutional investors now have more of a controlling stake in your company. They could guide the direction of your company a little bit more than you as an entrepreneur. So you need to consider all these factors when approaching a VC. It's not the end all to go and raise a lot of money from a Kleiner Perkins or a Emergence or one of these larger VCs out there. Just make sure that it fits into your vision and your plans on growing, because there's a lot of benefits, but there's also a lot of cost. So convertible debt versus equity, I think we've kind of touched on that, so I'll very quickly run through that. The convertible debt is very simple. Usually you could close a convertible debt round very, very quickly. There's not a lot of negotiation over valuation, so it's something that it's easy to do. Convertible debt, because there's no valuation talk, it gives the investor a lot of comfort in that they will be treated fairly when there is another round of financing. The convertible debt is a lot more flexible, meaning that a lot of times, you could have a convertible debt round of say $3 million and take a draw of say tranches of 500,000 at a time. So it's a lot more flexible. You don't have to, take all the money all at once. And as a result, that the dilution effect is in a convertible debt round, it could be potentially a lot less. And because convertible debt is so ubiquitous right now, that a lot of equity raises kind of take that into consideration, and it's fully understood by your investors. Equity rounds are usually come into play when a company is a lot more established, valuation is a lot more assured, and the biggest advantage of going out and raising a round, it gives you validation of your business, and it starts kind of a step ladder of valuation progression. So you could kind of look at it and say, okay, I've negotiated with institutional investors. I have kind of a line in the sand of what my company is worth. And as it grows and you raise additional rounds, it kind of gives you validation that you're in the right direction, and your idea and vision is progressing.
I'll go ahead and take over from here. So I'll make one final point that wasn't cut, that I don't think we actually explicitly stated. The convertible debt is a whole lot cheaper. An equity round of financing will cost tens of thousands of dollars. You won't, if you haven't been through it, you won't believe how voluminous the paperwork is for an equity round of financing versus a convertible debt. The lawyer fees involved, negotiations, it's a lot more expensive. So that's another advantage of a convertible debt over equity. Kind of moving forward into the strategy. If we could go to the next slide, we'll kind of start off with kind of a game plan. And these are some of the main things that we would want you to think through. And I'm going to kind of skip around here a little bit. But really, what are we using the money for? Is it product development? Is it time to market? Is it blowing out the sales and marketing piece? Is it advertising? What are we using it for? And a precipitate of that is that obviously how much money do we need? And it kind of going up to the first point, which is really a key one that we really focus on, is milestone financing. And what we mean by that is as you can kind of glean from what we've discussed, is that you're gonna get diluted, right? Every single time you raise a round of financing, you're gonna get diluted. And so the idea is to dilute yourself as little as possible. And the way you do that is you raise enough money in one round of financing, you hit some milestones with that money, that you raised, and then after you hit those milestones, you get a nice big, hopefully a big increase in valuation, and you raise more money to get you to the next set of milestones. And so by doing that, what you're doing is you're kind of step laddering along, both in terms of the amount of money that you raise, but hopefully also in terms of valuation, such that as you raise more and more money, as you grow and become more successful, you're giving away less and less of your company with each subsequent round of financing. And so that's kind of what you need to think through. And then the costs and the terms and the conditions, we kind of talked a little bit about that. That will all get kind of determined throughout the negotiation phase, and that's going to be more a matter of how much have we done, right? How much did we do with our initial money that we put in ourselves and with friends and family? How much did we do with our seed round of financing? What milestones did we achieve? Are we able to get more and more investors interested? In which case, obviously, we're going to get better terms from them. So, but the main thing here is to really think about what you're trying to achieve with the money that you're raising. Okay, next slide. So the process, we talked a little bit on the front end about what it might take in terms of raising convertible debt. If we're talking about raising VC money, and this is kind of where we've kind of now transitioned over into VC money, this is a long drawn out process. It says here timing 6 months out. We, depending on how easy it is, it can happen in 3 to 6 months. But I've certainly seen cases where it takes 6, 9, 12 months. And so, keep that in mind, and also the amount of resources that's required. I like to say that, trying to close a round of VC financing is a full-time job for one member of your executive team for 6 to 12 months. And that's really the level of effort it takes kind of throughout the process. And so keep that in mind. Things like, obviously you want to be, networking. You want to be in meeting as many investors as you can. You want to, think through, who you want to target. You want to rely on your ecosystem, and this is where companies like Early Growth comes in, and banks like First Republic and Silicon Valley Bank come in, and lawyers who are really tied into the startup space and the fundraising space. So you want to leverage everyone that but certainly there's a lot of players that you can rely on and hopefully leverage as you go through this process. Choosing your target VC. So this is where, obviously you want to do some research. You want to, think about things like, do the VCs that I'm targeting, do they have the right industry focus? Do they understand our space? As a corollary to that, what other companies have these VCs invested in that might either be a complement to what we're doing or a competitor to what we're doing, and that makes a big difference too. As Alaa mentioned before, a VC, once they come in and they join the board, or even if they're not joining the board, they are going to be a source for us. They're going to be a resource for us. They should be able to make introductions. That might be to other portfolio companies that they've invested in that can assist us, or maybe even partner with us, or we might be able to use some of their resources. So think through that. These other things like brand and support and network and location and expertise, all of those things obviously are important as well. But you really want to do your research so that when you actually reach out to the VCs that you're trying to target, that you kind of know, right? You know what the answer is. You're not going to kind of give them your pitch deck or your executive summary, and they're going to say, oh, this isn't really our space. Because obviously that's a waste of your time, their time, and that also makes us not look as prepared and professional as we'd like to show ourselves. So do your research and make sure you're targeting the VCs. And once you target the VCs, then you should do everything that you can to try to make the introductions get in to see them or to send them information, and hopefully be able to pitch them and get an investment from them. And then, to that end, obviously, networking is key. You may be a technologist, you may be an operations guy, or you just may be a visionary. But no matter what, you're going to be a salesman. You're going to be a salesman for a good amount of time. You're going to be selling yourself. You're going to be selling your company. You're going to be selling. You're going to be obviously selling the potential investment. And so, keep that in mind. If you're not that person, you want to partner up with someone who is. If you're an introvert and you just, you've got a great idea, but you just don't see yourself as being that guy who's going to be able to go out and really, really network, you should be partnering up with someone as a co-founder that is. But really, you need to be getting out there. You need to be talking up what you're doing. You need to be, making introductions. You need to be being introduced to potential investors, and not just today, right? Like not like, hey, I need money today, so who can I talk with? But think about, what you're going to need today, 3 months out, 6 months out, a year, 2 years out, right? You want to be networking and meeting all these people that you can right now. And the earlier you get started, the more network, the more people that you meet that might help you in the future. It's going to portend, more and more positive things. To that end, obviously, meeting other entrepreneurs that are, that are similar or in similar space as you is key. They can certainly help you. Co-locations and incubators, if you're not familiar with them, these are places where you can rent a desk or rent an office, and you're in with a whole bunch of other entrepreneurs similar minded, that and not only can the people within the colo or the incubators help you with networking, but the other entrepreneurs and the other renters of space in the colos or the incubators are going to be helpful as well. So keep that in mind, and even if you're doing something like working out of your garage or your home office and you're trying to save money, you can get, like I said, you can get a desk at a colo or an incubator for very, very little money, and have lots of resources.
Yeah, all excellent points, Sirk. The networking angle is so crucial from two really, really important areas. That when you're growing a business, it's important to attract talent, and it's also important to grow revenue. And it's amazing how many of my early stage clients, their first set of customers or their first key hires are not really from, whether it's customers from your sales team, it typically comes from your network, somebody who knows somebody at a company that is looking for your product, and introduces you. Or you're looking for a CTO or a VP of marketing or somebody, and somebody knows somebody that introduces you that's working someplace else, and they're a great fit. So getting a network out there not only expands your horizons for raising future rounds, but also helps your business become a lot more successful.
Absolutely. Great point, Alaa. Okay, and then the last section, and I know we're running a little bit short on time here, but the last session will just kind of touch upon, what you're going to want to prepare and what investors are going to want to see, and primarily it comprises of these three things, right? So, in order of short to longest, elevator pitch, right? An elevator pitch is just that, the classic. If you're stuck in an elevator and you got 1 minute, and someone says, "Hey, what do you do for a living?" or "What's your idea?" It should be something where you can, in 30 to 60 seconds, really explain, not necessarily explain, but certainly to be able to convey the vision that you have and what you're trying to achieve. The executive summary is a kind of a little bit more information where someone says, "Hey, I'm interested. Send me something. Give me a little bit of information about your company, where you're at." And so this should be like a 1 to maybe 2 page document, PDF, something like that, which you could fire off, and it'll give an investor the particulars, right? What the product or idea is, who you are. What stage of the company are you in? Are you in revenue? Are you in product development? Maybe the size of the company. Relative levels of revenue if you're generating revenue. So just a basic idea of what you do, but enough marketing in there so that someone who looks at it says, "Wow, this sounds great. I want to learn more." Or I thank you for this. I know somebody who might be interested in this space. Let me forward this to him or her. And so that's what an executive summary is. And then the final one is the pitch deck, and this is the slide set that you're going to be sending to potential investors, and which you're going to be presenting when you hopefully get an audience with an investor to really go through your idea. The next slide is just a, this is a pitch deck, right? So it should be very, very high level. 10, 12 slides is really all you want to present, and really all the time that you're going to have to present if you're invited to pitch your idea with a VC. And I think Guy Kawasaki, who's a legend here in Silicon Valley, he uses the 10, 20, 30 rule, which is 10 slides, 20 minutes, 30 font, right? And what that means is that you really want to keep it high level. Again, this is not where you're going to be going through all the details of everything that you're doing, all the technical ideas. If you can whet the appetite, the idea of a pitch deck is to get the investor excited enough where they want to take the next step. And the next step would be due diligence, right? And during due diligence, prior to an investment, is when you're going to go through all the details, and you're going to have financial plans, and you're going to have real technical white papers if it's appropriate. You're going to have market segmentation data. There's going to be a ton of data, but in your pitch deck, you really, really want to keep it high level. Charts are good. You don't want a whole bunch of, eye strain charts or eye strain verbiage. Something like this, where you highlight, problem solution, the market opportunity, what our technology is, or what our secret sauce is. A slide on competition, a very, very high level on what we think the financials are going to look like. And then the key, we talked about milestones again and what we're trying to achieve. And really the funding requirements, right? So ask for the money. I'm looking for $1 million, and with the money, with the $1 million, this is what I'm going to do with it. And ask for the money, and that's kind of what this is. And then of course, being financial folks, it'd be I'd be remiss to not mention something about financial slides. In the pitch deck itself, you're just going to want to, again, a very, very high level. You're going to want to put something in terms of revenue projections and the funding requirements, how much you're looking for, and the use of funds. Again, the milestones that we're trying to achieve, right? Because this is, if we're going after VC money, you're not going to get one round of VC money and all of a sudden, knock it out of the park and never need money again. In most cases, you're going to be going after a seed, followed by a Series A, followed by a Series B, and maybe even beyond that. And with each round of financing, you're trying to get bigger and bigger and bigger, and hit more and more milestones. And so, the idea is to say, I need this much money today. These are the milestones that I'm going to hit. And in this time frame, this is how I'm going to use the money in anticipation of the next round of financing, which will obviously come at a much bigger valuation, so that all of our shares are worth a lot more in the next round of financing. And then in terms of financial projections, this is usually at an early stage. If you're kind of really just getting started now, this is very, very difficult, right? Because it's really hard to know. But at least understanding, we have two ways of looking at financial projections. We have a top-down, which is really the way that we would kind of extrapolate what we think the potential revenue is going to be for our company, and then we have a bottoms up, which kind of takes that revenue and then kind of builds up what our expenses are going to be. But starting, I apologize, Amanda, if we could go back up there. So you start with a market size. You kind of whittle that down a little bit further into particular segment, whether that is by industry focus, particular market we're going after, maybe particular geographies we're going after. But anyway, in any case, we're not going to start off by saying we're going to take over the world, right? We're not going to be going after how many ever billions of people there are, consumers there are. We're going to be going after a small niche. And so you use that and you extrapolate what we think we're going to be able to get in terms of potential revenue, and put together kind of like a top line revenue plan that we can communicate to investors. And then using that revennew plan, then you can say, okay, well, based upon the revenue plan and the timing of the revenue plan, this is kind of what we're going to need. And Amanda, if we could go to the next slide. And so basically, okay, in order to achieve these revenues, this is what we need to do, right? This is these are the people that we need to hire. This is the amount of money that we need to spend in terms of product development. This is how much money we have to spend in terms of sales and marketing, advertising, operations, customer support, right? So all of those things should kind of roll up into maybe CapEx if we're a capital intensive company. All of those things kind of roll up into what I would call a high level financial plan, and what should fall out of that is, again, kind of this, how much money do we need, right? How much money do we need to achieve these targets from a revenue perspective, as well as hiring and expenditure perspective. And that's this is where I would say that you want to, unless you're really experienced, have been through this, and understand how to pull together a financial plan, you probably want to work with someone who's helped companies put together plans like this. Obviously, companies like Early Growth, but even if you certainly don't need to be using a firm like ours or specialists. You might know people who have done this before. You might know other entrepreneurs who can assist you. You might be savvy enough to do it yourself. But in any case, what you want to do is you want to make sure that the financial plan kind of ties in, right, with a pitch deck, and ties in with the amount of money that you're asking for, and it's believable and it's achievable, and yet still compelling enough where an investor is going to want to say, got it, I understand that, I can see how we can get there, and yes, based upon this and based upon the belief in the market and the belief in you as the entrepreneur and founder, I want to invest in this company. That's kind of what all this is about. And I think that this is the final slide here, and apologies for going a little bit over. But yeah, this kind of, I think we kind of, we've already discussed all of this already, which is, how much do you need to raise to meet your objective in this round of financing, not in total. Right? Don't raise too much today because you're going to get diluted out, right? If you don't have the business, if you don't have the results and the past history, and you try to raise too much money, then first of all, it's going to be hard to raise that money from investors because you don't have the you just don't have the history. And secondly, even if you are able to do it, you're going to have to the valuation is going to be such that you're going to be giving away more of your company than you need to be. And we talked about the considerations about how much, where the money's going. And obviously you need to think through that. The last thing we want to do is put together a plan where the investor says, oh, great, this sounds good. I like your idea. I like the market potential. But hold on a second. You are either, looking to hire way too many people and you're going to burn through cash too fast, or I don't understand how you're going to actually, hit these milestones and achieve what you're trying to achieve with the financial plan here and the hiring plan that you have, because I don't think it's possible. So, obviously, earning the confidence of the investor is really, really key. And part of that is really understanding your model and being reasonable and yet achievable and yet, positive and confident. So, I know that that's a lot of things to consider as you put all of this paperwork and documentation together, but it really needs to be thought through at this intricate of a level so that you are putting the best foot forward. And so I think that's it. I don't know, Alaa, if you had something else to add. I know we're already 5 minutes past the hour, and our apologies on that. And obviously, we know your time is busy. I personally am available if there are people who have questions that want to stay on. I'm more than happy to stay on and answer questions. And I'm not sure, Alaa, what your availability is.
Absolutely.
Hi, so I do have one question right now. Will VCs not invest with competing companies?
No, they might. You got to be careful, right? It depends on how competitive it is. Like if it's a direct, I'm doing the exact same thing as another portfolio company, probably not, right? And in fact, you got to be careful when you're pitching VCs like that, because they may very well be saying, okay, I want to see what these guys are doing. I've already invested in a company that's obviously doing the same thing, and I'm just doing some competitive research, right? So you want to be a little bit careful. But there's a lot of VCs who like specific industries, right? And they want to make multiple bets, right? They their idea is they want to hit one home run out of 10 companies that they invest. And if they're able to do that, then they're successful. So, a lot of them don't want to put all their eggs in one basket. And to the extent that you have a compelling idea that maybe skirts around something else that one of their portfolio companies are doing, and you're able to convince them that you are the right entrepreneur, and you can earn their confidence, they will invest in companies that are somewhat competitive or can be competitive. But probably not 100% overlapping.
There is no clear-cut policy in venture capital firms that restrict them from doing that. You need to, as an entrepreneur, you need to be careful. However, if it's your only funding source and you need to raise money to be successful, and the VC that's looking at you has an investment in a competing or a similar industry, then I think maybe your choices are few. But you just need to make sure that that you go into it with open eyes. I have a company that it was very interested in a venture capital term sheet, but they found out that they were investing in a very similar company and chose to go to another direction. In another direction, it wasn't the VC that was restricting the investment; it was really the company that chose not to get the financing from that company for those reasons.
Yeah. I mean, we have to do our research, right? And again, it kind of goes back to targeting the right VCs, that you want to go after. I mean, there's so many of them out there, so it shouldn't limit us in terms of our opportunities to find appropriate VCs to pitch to.
Thanks. Another question is, will VCs sign NDAs?
I was almost even going to mention that as part of the answer to the last question. Absolutely not. No VC will sign NDAs. You can't expect them to. If you ask, you'll come across as being not very knowledgeable. No, they will not sign NDAs.
Okay. One more question. Is there software that you recommend for cap tables?
Alaa, there are lots of online SaaS cap table management software.
Yeah, the one that we work with at Early Growth very closely is CapShares. But there's also another company that used to be called eShares. I think they're currently called Encarta or Carta or something like that. They just changed their name. but those are two excellent sources. They're very early on. They may not be necessary very early on. You might want to keep your cap table in an Excel spreadsheet, but definitely once you start having an option plan, for example, they're great. They're a great tool. They not only help track your investments, but they help with managing your option plan, and they also issue a whole host of reports that, especially when you get a venture capital investment that you're going to need to generate for your VCs, and it makes that process a lot easier. Definitely recommend once you've established a stock option plan.
That's right. So you won't need it initially when it's just common shares and it's you and your founders and maybe a couple of key employees. You won't need that. You certainly won't need it when you're doing a convertible round of financing. But once you raise that first round of equity financing, and with that, there's, like I said, there's a whole slew of paperwork, including things like an option pool that you're establishing to be able to attract employees. Then that's probably going to be the time that you're going to want to look into a CARTA or CapShare.
Great. Looks like that's all of our questions for now. We're going to go ahead and send up a follow-up email to everybody with the recording and also with the slides. So feel free to reach out on that if you have any additional questions. Otherwise, thank you so much to Alaa and Sirk. This was fantastic.
Thank you, and goodbye, everyone.
Thanks.